We are now living in one of the weirdest times in recent history. On one hand, the Fed has raised interest rates to the highest point in over 20 years. On the other hand, the stock market has been going to the moon. S&P 500 up by 20%, Nasdaq 45%, and the Dow Jones has been going up for 13 days in a row. The only thing that could make this weirder is some UFOs appearing out of nowhere. Anyway, it seems like we are almost back to the good old days of 2020, where no matter what we buy, we are almost guaranteed to make money. So now, the question that's on everyone's mind is, where do we go from here? Are we really in a bull market? Or is it just a fake bull run? And more importantly, how should I invest my money now? But do join my Telegram community of over 4,000 members to discuss everything about money and ask any questions that you may have. Also, this video is produced in collaboration with Phillip Capital, but more on that later. Alright, in order to understand where the market will go from here, let's take a look at the federal funds rate first. Just last week, Papa Power increased the rates once again, bringing it to a range of 5.25% to 5.5%. However, that's not the interesting part. Instead, it's the part where he says that they will raise funds again if the data warranted. When compared to just a few months ago, this is a big change in tone. Previously, they were still saying that they are planning more hikes in order to fight inflation. But now, it has changed to, we will either raise funds or we will hold steady, depending on data, meeting by meeting. Or in Singlish, the Fed be like, see how low? So, will the Fed increase interest rates or not? Let's look at some inflation data. In July, we saw that the CPI inflation has dropped to 3%, which is at its lowest level since March 2021. Many of the categories that initially contributed to the high inflation are now coming down. For example, food inflation has come down, energy down, and even going into the negative range. Electricity down, new vehicles down, used cars and trucks down, transportation services down too. The one thing that still remains stubbornly high is, you guessed it, shelter once again. That's because shelter inflation typically lags by 6 months to a year. If we look at real-time data by Bloomberg, the national rent growth has been decreasing. Zillow reported the same thing. So give it another few more months and we will start to see shelter inflation drop. And with shelter making up about 1/3 of the inflation, we will see inflation dropping a lot faster when this happens. Other than shelter, commodity prices also contributed a big part to the inflation. So how are they doing now? Natural gas has dropped by 70%. Coal has dropped by a lot too, both of which make up about 60% of US energy sources. So again, we will see energy and energy service inflation to start dropping a lot more too. Okay, Brent crude oil prices did go up recently, but they are still lower as compared to last year. Other stuff like copper, iron, corn, wheat, soybeans have all come down too. So as you can see, many of the parts that initially contributed to the high inflation are now starting to come down. That's why even when the Fed say that they might raise interest rates in the next meeting, the market be like, I don't believe you. And almost 80% of the people thinks that the Fed won't be raising rates anymore. Quick pause. If you are looking for the best place to park your idle cash, I have a lobang for you. In celebration of Singapore's 58th national birthday, Poems by Phillip Capital is running a time-limited promotion. They are offering a 5.8% per annum guaranteed returns on funds deposit for 30 days. These returns easily beat other banks, bonds, and even money market funds in the market right now. And the best part, this deal is available for both new and existing users. To qualify, you can sign up with my link down below. Do make sure that Smart Park and CFD are both ticked during the sign-up process. Then deposit anywhere between $1,000 all the way to $50,000 and you will automatically qualify for the promotion. For existing users to participate, make sure that you have opted in to Smart Park by going to Poems, Account Management, Online Forms, Account Application, and enabling Access Fund Authorization. This deal is only valid until 31st August. So if you are interested, you can chop sign up with my link down below. With that being said, let's get back to the video. But what about a recession? Can it still happen? Here's what the data says. First, the job market has been incredibly resilient despite all the rate hikes. Even though non-farm payrolls increased lower than expected, unemployment rate remains low and wage growth slightly beat expectations. GDP also beat expectations despite recession cause. This puts the economy in a really good spot, where the Fed might actually be able to achieve the legendary soft landing after all. Soft landing is when the Fed is able to raise rates without causing a recession. And that's really good because historically, the S&P 500 tends to crash hard during recessions, and now we may just be able to avoid a recession. However, some will point out that the yield curve inversion is still happening. Isn't it supposed to be inverted yield curve equals recession coming soon? Yes, that's true, but there's a simple explanation for this. You see, bond yields are affected by the demand. The higher the demand, the lower the yield. And if you check the 10-year treasury yield, it's giving a rather high 4% yield. This makes it super attractive for many investors to buy the bond and lock in a guaranteed yield for 10 years. And that is the simple reason why the 10-year bond yield is now lower than a 2-year bond yield, which causes the inversion. So then, is this bull market real? And are we in a bubble? Depending on who you ask, you will get different answers. Bank of America predicts that the S&P 500 will test all-time high this year. And while Jim Cramer is bullish about the S&P 500, according to the inverse Cramer's rule, he's bearish now. While everyone's prediction is all around the place, here is some data to consider. First, as of last week, almost 50% of the S&P 500 companies have reported their earnings. And so far, almost 79% of them have beaten analyst expectations. Google, which grew their earnings and cloud revenue. Meta beat expectations while also issuing an optimistic guidance for the next quarter. Even Tesla, which everyone thought had demand problems, also achieved another record quarter despite the current economy. If you look at the S&P 500 PE ratio, while it is relatively high when compared to previous periods, this doesn't always mean that a crash will come. For one, due to advances in technology, our labor productivity has increased. This means we are able to output more stuff for every hour that we work. This is very clear when we compare the companies in the S&P 500 now versus the companies back then. Back then, it was mostly industrial companies, but now many of them have been taken over by tech companies, which can grow a lot faster. And guess what? This increase in productivity will increase a lot more from here on. Why? AI. AI is here, and no matter where we look, there's AI. AI everywhere. Tesla is working on their AI robots and AI car. Google has their AI chatbot. Adobe has their AI softwares. And even though Apple doesn't talk about AI, like it's some dirty word, they are also actively hiring AI people. But AI is not just limited to tech stocks. It's also in the gaming industry now, entertainment, healthcare, consumer discretionary, financials, real estate, and more. But as to how much AI will affect companies' earnings, different analysts have different expectations. Goldman Sachs says that AI could push S&P 500 profits up by 30% over the next 10 years. PwC estimates AI will make the world $15 trillion richer by 2030, or about 14% of the global GDP. Bank of America predicts that the global AI market will grow at 19% compounded annual growth rate, and Accenture thinks that AI will lead to a strong increase in productivity by up to 40% due to automation. Okay, here are my thoughts. While interest rates are high, we are in a good environment where recession seems unlikely and the stock market seems to be back in its bull run mode. As long as there's no unexpected events happening, like another war or some alien invasion, this bull run may just go on for a while longer. But whichever the case, my strategy has always been consistent throughout it all. Just buy good companies, don't try to time the market. Market up, you buy. Market down, you cry a bit, then you buy more. And over the long term, you will do well. Anyway, that's all for this video. Hopefully, you find it useful. Like, share, and subscribe as I'll be posting new videos every Monday, Wednesday, and Friday.